Greetings, Dwayne from CFRN with a ultra fast recap of all trades from the 29th day of March. Is that correct? It is March the 29th, 2012. I'm going to move quickly. I keep promising you I'm going to learn to move quickly because I just want to get us caught up to the current day, which is currently April the 3rd, 2012, and then we'll do a little more leisurely, explanatory, blah blah type of video each and every day. I needed to create some history. Alright, so here we go. Not that we don't have history. We've been on the air for 6 years, 5 years of podcasts out on the internet that you can listen to. You can take our free trial by going to cfrn.net/apply, or just go to cfrn.net and click one of the many apply buttons, and that will take you to the free trial. Pretty simple stuff. Alright, let's get rolling. The vertical line here, midnight Chicago time. Okay. The MA1 is above the BBC. Conditions are bullish. We're looking for a pullback to get long. We get a pullback right here. I don't need to measure this or do anything with it. This trade, if you simply took the pullback right here, you got stopped out. That needs no further explanation. We then get a bearish cross. Price pulls back to the BBC. We have an entry to go short. Now we get out the old measuring stick. This is my horizontal line tool. I normally use it for my weekly trading zones, hence the WTZ. This is not a weekly trading zone. I'm simply using this tool to show you the price that we pulled back to, which is 1397.25. From there, price declined to 1386.50. Let's shrink this down a little bit. Let's pull it in tighter. Shrink it down some more. Come on. There we go. Alright. Now I can do our math. Hey, remember, the signal to go short was right here. The first signal was to go long, stopped out for 2 points. Next signal to go short at 1397.25. And then price falls to 1386.50. And that, with the help of my handy dandy calculator, can't be right. Let's do it again. 1397.25 minus 1386.50. Yeah, I guess it was right. Okay, we had a decline, stem to stern, of 10 and 3/4 points. Okay. Do I expect that you would have stayed in for the entire move? Maybe you did, maybe you didn't. Number one, I don't know if you caught the entry. You have to ask yourself that. Were you up trading at 6:55 Chicago time? 6:46 Chicago time? Were you? If you were, then this very well could apply to you. Okay? If not, it doesn't. But I've said that in the previous video, so I won't belabor that in this video because I just want to get caught up. Alright, what does price do? Price drops. Nice drop. Pulls back. There's a secondary sell signal, followed by yet a third sell signal. Now, if a person had taken this signal here, this pullback to 92, the drawdown on that was a 0.93, so using our rule of a 2-point stop, you would have not gotten stopped out. You had no drawdown here, and you're guaranteed a fill because we do put our entry one tick below the BBC. So if it touches, the fill's guaranteed. And unless you're trading an awful lot of contracts, you got them all filled. Okay. All right. So entry there, entry there, entry there. Maybe you took 2 points here. Maybe you took 2 points here. Maybe you took 2 here. Maybe you didn't. Maybe you went fishing on this day. See, be careful of the guys that tell you what happened and what you did, because maybe you didn't. All right. What really happened is from our original entry signal to go short, price fell 10 3/4 points. And if you're looking for an average of 2 points a day, well, there's a whole week right there. Then we get this beautiful double bottom. Okay. But before we can talk about the double bottom, we got to talk about this. Price gets above, gets on the back side of the MA1, gets above the BBC. Price pulls up. Okay, we have a bullish cross, and we have an entry right there to go long. Now, without using any of our other tools, the cycle indicator, the DMT, the slingshot, weekly trading zones, I'm trying to make this as basic as possible. If, after that lengthy decline, you're sure you caught the bottom and you're ready to go long, you're getting long at 1389.75, and price goes up to, there is an opportunity to grab 3 ticks, but you know what? The reality of you grabbing 3 ticks out of that trade, not very realistic. So what we're going to do, let's put our X over here on that first trade. Remember, they got stopped out long. 2-point loss. 10 3/4 point decline, which was, we had the direction on that. Here, let's just call it a worst case scenario. You get stopped out for 2 points if you took the trade. If you didn't take the trade, guess what? You didn't get stopped out. You get a bearish cross. Okay, bearish cross. You get triggered into the trade at 1389, and price proceeds to drop to 86 1/4. So 1389 minus 1386 1/4. It's a 2 3/4 point decline. If your goal is 2 points a day, there it was, right there. If you took a secondary entry here, now this was measuring from here to here. If you took this secondary entry, you didn't get much. If you took it, 88.25 would have been the entry to go short. 86.75 let's see, 88.25 minus 86.75. There's 1.5 points on the table. Okay, were you nimble enough to at least get a point out of the 1.5? All depends on if you took the trade, and I don't know if you did, so I can't say. All right, moving right along. So far we've had 2 trades that get stopped out, and a lot of opportunities that made for some very nice trading. Okay, the tables turn right here. We get a bullish cross. The CFMA1, the backbone of the CFRN indicator set, is now above the BBC, the green line, and we're ready to go long. We don't need to look at anything else, think about anything else, go figure anything out. Right there, we get triggered in for a long trade. And the entry to the tick. And we always know the entry because over here it'll be highlighted in green. Okay, I'm having to use this little tool to kind of measure it for you. Okay, the pullback there would have been to 13.89. You'd have had a tick. No, you know what? Let's see. The low of this candle is 88.25. You had 3. You could add 3 ticks of drawdown. Maybe even 4. Maybe even 4 ticks of drawdown right there. Worst case scenario, you had a 1-point drawdown. Then what happened? Price ran up to, let's call it 1400. It looks like 99 cents. Well, we'll call it 99.75. I think that's what it is. So 1399.75 minus 1389, a 10 3/4 point rally. Wow, that sound familiar? How does that happen? Why does that happen? Little thing called support and resistance, supply and demand. Depends on the school of trading you attended. Okay. Looks like there's one more move for the day. If you bought this final pullback right here, your entry would have been $13.97. Price rallied to 1403.50. 1403.50 minus 13.97. 6.5 point rally. 6.5 points. Now, would you have gotten it all? I don't know. Would you? If you bought it here, would you have known to sell it here? I don't think so. But you might have. Let's look left. Is there anything there? Oh my goodness. Look at there. You just might have. See? See where the market peaked? At the very beginning of this video, the high of that candle was 1403. Is that right? 1404. Then over here at the end of the day, what's the high? 1403.50. Was there an opportunity to get a couple points out of there? Yes, indeed. And where was the entry? Same place it is every single time. It doesn't change. Not on this trade setup, not using these 2 indicators. We got more indicators, we got more setups, we trade more markets. Just trying to get everybody caught up on the S&P 500 E-mini futures. Come take the free trial, cfrn.net/apply. This is Dwayne, signing off.